The $100 silver target is no longer a prediction. It's a pressure point because in just 36 hours, silver crashed, then snapped back, while physical buyers paid more as paper sellers dumped contracts. Bond yields fell hard, liquidity stress surfaced, and the Fed's options narrowed. So the real question now isn't if silver moves higher, it's what happens when policy shifts and positioning flips. Because when paper pressure meets physical demand, price doesn't adjust slowly, it resets. Welcome to the channel. If you've been through a few market cycles in life, you already know the biggest moves usually start quietly. So here's a small request from one serious investor to another. If you value calm, logic-based market analysis without noise or drama, do consider subscribing. It genuinely helps this work continue. And do share in the comments which country you're watching from today. Let's begin. He first noticed the pattern not in headlines, but in repetition. Silver had approached $80 again and again and again. Each time it moved close, markets reacted as if a ceiling had been touched. Analysts called it a resistance. Traders called it a sell zone. Commentators called it overbought. Yet what caught his attention was not the rejection itself, but how quickly silver returned after each retreat. Prices were not collapsing away from the level. They were hovering beneath it. To an experienced observer, that behavior carries meaning, because commodities do not linger below resistance unless pressure is building above it. He began reviewing the broader structure. Silver had spent weeks trading between roughly $70 and $80. The range looked stable on charts. Volatility appeared normal. Nothing in the price alone suggested urgency. But he knew price alone rarely tells the full story. He turned to physical indicators. Premiums on coins and bars had not fallen during pullbacks. Dealers reported steady buying. Inventory movement in exchange warehouses showed continued drawdown rather than replenishment. None of these signals matched the narrative of a commodity failing at resistance. Instead, they suggested absorption. Absorption is the process by which supply offered at a level is gradually taken by buyers until the level weakens. It happens quietly. Each time price dips, buyers step in. Each time it rises, sellers appear. Over time, available selling inventory thins. The level remains intact visually, but structurally it weakens. He recognized the pattern from past commodity cycles. Markets often compress below major thresholds before repricing. The compression phase looks calm. Participants assume equilibrium, yet beneath the surface, physical conditions tighten. Silver near $80 was behaving that way. He compared it with earlier cycles. In previous decades, silver rallies often coincided with speculative surges. Futures positioning expanded rapidly. Price rose alongside leverage. When speculation reversed, price collapsed. Those cycles were visible through sentiment and positioning data. This time looked different. Speculative exposure was not extreme. Managed money participation remained moderate. Retail frenzy was absent. Financial media attention was limited compared with past peaks. Yet price remained elevated relative to prior years. That combination suggested structural support rather than speculative excess. He then examined supply fundamentals. Global silver production grows slowly. Much silver is mined as a byproduct of base metals. Output depends more on copper and lead mining decisions than on silver price. When silver demand rises independently, supply cannot respond quickly. Industrial consumption had also expanded. Electronics, solar technologies, electrical systems, medical applications, all required silver's conductivity and durability. Many of these uses are not price sensitive in the short term. Manufacturers cannot easily substitute or delay production due to moderate price changes. This creates persistent baseline demand. Against that baseline, exchange inventories had declined over time. Deliverable stocks in major warehouses trended lower than historical norms. Each ounce leaving inventory represents supply already absorbed by end users or investors. He considered the implication. When inventories fall while price remains stable, markets are absorbing supply quietly. Price does not need to rise immediately if inventory fills the gap. But as inventory shrinks, remaining supply becomes less elastic. Eventually, price must adjust to ration demand. He saw silver approaching that stage. The repeated approach to $80 reflected that tightening. Sellers were still present, often short-term traders or hedgers, but their ability to push price downward diminished after each attempt. Buyers returned faster, dips shortened, recoveries accelerated. This is how resistance transforms into support over time. He imagined the structure visually, a ceiling above price, but pressure building beneath. Each contact weakened the ceiling slightly. From outside, nothing dramatic appeared. From inside, stress accumulated. He also observed the difference between paper and physical behavior. Futures prices fluctuated with financial flows, but physical premiums, the price above spot for coins and bars, remained firm or rising. When physical premiums hold during price pullbacks, it signals that real buyers are not retreating. The physical market was not behaving like a commodity near exhaustion. It behaved like one near scarcity. He did not assume breakout inevitability. Markets can remain in ranges longer than expected, but the configuration differed from typical sideways trading. Normally, stable ranges show balanced inventory, moderate demand, and neutral sentiment. Silver's range showed declining inventory, steady demand, and cautious sentiment. That combination often precedes repricing phases. He then considered psychology. Investors remember prior peaks. Silver's historical spike decades earlier created long-term mental anchors. Many traders assume silver cannot sustain higher levels. That belief itself becomes supply. Sellers appear at remembered ceilings. But if underlying conditions change, tighter supply, stronger demand, monetary shifts, historical anchors lose relevance. Price must establish new equilibrium. The transition period often appears as repeated testing of old limits. Silver near $80 resembled such a transition. He reviewed currency context. Precious metals trade relative to fiat units. When monetary conditions shift, inflation expectations, liquidity, interest rates, metal valuation can adjust without immediate changes in physical supply. Silver had experienced cycles tied to monetary policy before, but current conditions combined monetary and industrial drivers simultaneously. That dual support strengthened the floor beneath price. He wrote in his notes, price stable near resistance, physical demand steady, inventories declining, speculation moderate. This is compression, not exhaustion. He then returned to the chart. Silver moved again toward 80. The movement was not explosive, it was measured. Yet the pattern remained, each pullback shallower, each recovery faster. Traders watching only price saw repetition. He saw progression. Markets often signal structural change through persistence. When an asset repeatedly approaches a level despite selling pressure, it suggests buyers are accumulating. Accumulation phases appear uneventful. Only later does breakout confirm what was already occurring. He concluded that silver's behavior near $80 differed fundamentally from past tests. Earlier cycles showed speculative spikes. Current behavior showed structural tightening. The distinction matters for decision makers. Speculative peaks reverse sharply. Structural repricing phases advance gradually, then accelerate. Silver had not yet broken 80, but the environment beneath price had shifted. Physical absorption, constrained supply response, and persistent industrial use formed a base unlike previous rallies. He summarized quietly, the level has not changed, but what lies beneath it has, and in commodity markets, what lies beneath price determines what happens next. He had seen commodities tighten before, inventories fall, demand persist, prices rise slowly. But what changed the equation, what turned tightening into repricing, was almost never the metal itself. It was money. He shifted his attention from silver charts to the bond market. Because in modern economies, commodities do not move alone. They move within monetary systems. And monetary systems move through interest rates. The signal appeared quietly at first. Treasury yields had begun to slide, not dramatically, not in panic, but steadily enough to suggest that large capital was repositioning. Bond markets rarely shout. They adjust early. When yields fall, it means investors are accepting lower returns to hold government debt. They are prioritizing safety over growth. They expect weaker economic conditions ahead. This shift in expectation matters for metals. Because silver and gold do not yield income, their attractiveness rises when competing assets yield less or appear riskier. Falling yields therefore reduce the opportunity cost of holding metals. But he knew this relationship alone was not enough. Silver had lived through low-yield periods before without sustained repricing. Something else was emerging now, something tied to policy constraint. He reviewed central bank communications. Officials continued emphasizing inflation control. Rates remained elevated relative to the previous decade. Yet economic data had begun softening. Growth indicators slowed, credit conditions tightened, risk assets showed volatility. This created tension inside policy. If inflation remains above target, rates must stay restrictive. If growth weakens, rates must fall. Both cannot occur simultaneously without trade-offs. He recognized the pattern from earlier cycles. Monetary authorities often maintain restrictive stance until financial stress accumulates beneath the surface. Then, when adjustment becomes unavoidable, policy pivots quickly. Markets attempt to anticipate this pivot. The bond market was doing exactly that. Yields falling while policy remained formally tight suggested investors expected easing ahead, not immediately announced, but increasingly probable. Such expectations influence metals before policy changes occur. He examined historical episodes. During previous easing cycles, precious metals began repricing during anticipation phase rather than implementation phase. Capital rotated toward hard assets when confidence in currency stability weakened, not when easing was already complete. Silver had entered that anticipation zone. He then considered another dimension, liquidity. Financial systems operate on availability of credit and reserves. When liquidity tightens, asset prices often fall. When liquidity expands, asset prices rise. Metals respond strongly to liquidity expansion because they are outside the credit system. He tracked liquidity indicators. Banking conditions had tightened relative to prior years. Funding costs rose. Credit spreads widened modestly. These were not crisis signals, but directional shifts. If sustained, they increase probability of policy accommodation. Policy accommodation historically includes rate cuts or balance sheet expansion. Balance sheet expansion, often called asset purchases, increases currency supply. More currency units chasing finite real assets raises nominal prices of those assets over time. Metals, being monetary alternatives, often reflect this effect. He did not assume immediate expansion, but markets price probability, not certainty. If participants believe easing likelihood is rising, they reposition gradually. Metals benefit from this repositioning long before official action. He then returned to silver's behavior near $80. Part 1 showed physical compression beneath resistance. Part 2 now revealed monetary context changing above it. Physical tightening below, monetary softening above, two forces moving toward alignment. This alignment is what creates catalyst phases in commodities. He wrote, when physical scarcity meets monetary easing expectations, repricing accelerates. He also noted the psychological dimension. Investors remember recent inflation cycles. Metals rose sharply during previous liquidity expansions. That memory persists. Even modest signs of policy shift can trigger anticipatory flows back into metals. But unlike previous cycles, silver now carried industrial demand support as well. Monetary drivers and industrial drivers rarely align perfectly. When they do, metal valuation sensitivity increases. He then examined currency dynamics. Precious metals are priced in fiat units. If monetary policy loosens, currency purchasing power expectations weaken. Metals often adjust upward relative to currency. This does not require hyperinflation or crisis. It reflects relative valuation shifts. The bond market S yield decline hinted that investors expected policy normalization lower, effectively reducing real returns on currency-denominated assets. That expectation alone can reprice metals. He considered timeline. Policy shifts rarely occur overnight, but markets move ahead of them. Silver did not need rate cuts announced to approach breakout conditions. It required only credible expectation that policy would ease under economic pressure. The bond market had begun forming that expectation. He also recognized a subtlety. Monetary policy affects gold first, silver second. Gold responds primarily to currency expectations. Silver responds to both currency and industry. Therefore, when monetary signals strengthen, silver often follows gold, but with amplified volatility. If monetary easing probability rises while physical silver tightens, silver's sensitivity multiplies. He summarized the structure forming. Physical compression near resistance, monetary expectations softening yields, currency confidence marginally weakening, industrial demand persistent, 4 layers aligning. He imagined the moment when recognition spreads. Investors watching yields notice trend. Analysts revise policy forecasts. Capital rotates incrementally toward metals. Price tests resistance again, but this time under different macro backdrop. Resistance formed under restrictive policy may not hold under easing expectations. This is how monetary catalysts convert compression into breakout. He closed his notes with a measured conclusion. Silver's approach to $80 was not occurring in isolation. It was occurring alongside early signs of monetary shift. And when metals tighten physically while money loosens structurally, price levels inherited from prior regimes lose authority. The level may still appear intact, but the regime beneath it has begun to change. He knew that markets rarely move because of belief alone. They move because of position. Somebody is long, somebody is short. Somebody must eventually be wrong. Silver had approached $80 many times. Each approach looked similar on charts, but he suspected something different now. Not in price, not in fundamentals, but in positioning. He opened the futures exposure data. Short positions remained heavy near the same level. This was not unusual. Major resistance levels attract sellers. Producers hedge. Traders fade rallies. Funds bet on reversal. The logic appears sound. Sell near ceiling, buy lower. But repeated failure to push price down changes risk. Each time silver approached 80 and retreated only briefly, short sellers remained. They expected another rejection. Their positions accumulated near the same level again and again. This creates a structural condition. When sellers concentrate at one price, and that price becomes fragile. He had seen this pattern in other markets. Resistance does not break because buyers suddenly surge. It breaks because sellers become trapped, and their positions, once comfortable, turn vulnerable as price refuses to fall. He studied the recent behavior closely. When silver dipped below 75, selling volumes spiked. Futures contracts surged. Algorithms triggered stops. Yet price rebounded rapidly. The dip did not extend. Buyers absorbed the flow. This was important. A true bearish market extends declines easily. Sellers pushed price lower without resistance, but silver's declines shortened. Each sell-off recovered faster than the last. This indicated that underlying demand was consuming supply faster than shorts expected. Short sellers rely on continuation. Without continuation, they accumulate risk. He mapped the mechanics in his mind. A trader short at 78 expects price to fall towards 70 or lower, but if price instead stabilizes and rises back toward 80, that position becomes uncomfortable. Losses expand, margin pressure increases. When many traders share the same assumption, discomfort spreads simultaneously. He examined technical charts. The $80 level appeared obvious. Psychological numbers often concentrate orders. Above 80 likely sat clusters of buy stops, orders to purchase once resistance breaks. Below 80 sat sell orders, attempts to defend the level. This is how modern markets organize around thresholds. But thresholds change character when tested repeatedly. Each test consumes resting supply. Sellers defending the level sell again and again. Their available inventory declines. Eventually, defense weakens. He imagined the order book metaphorically. A wall at 80. Each rally strikes the wall. Each retreat removes a few bricks. From distance, the wall appears intact. Up close, it thins. Then comes the moment when demand slightly exceeds remaining defense. Price moves through. He also considered algorithmic participation. Modern trading systems monitor technical levels automatically. Breakouts, above widely watched resistance trigger momentum strategies. Algorithms buy when thresholds fail to hold. Their objective is not belief, it is reaction. Thus, a level break converts sellers into buyers in two ways: shorts covering and momentum systems entering. Both generate upward flow. This dual mechanism accelerates movement. He had seen this in other commodities: copper above long-term ceilings, oil above consolidation bands, gold above historic highs. In each case, prolonged compression beneath resistance produced violent breakout once positioning flipped. Silver now displayed similar compression. He also observed that speculative long positioning was not extreme. This mattered. Overcrowded long markets break downward when sentiment shifts. Underpositioned markets break upward when resistance fails. Silver belonged to the latter category. Few were excessively long. Many remained cautiously short. This imbalance favored upside asymmetry. He wrote, "Resistance holds until shorts dominate. Resistance fails when shorts accumulate too heavily." He then connected this with part two. Monetary expectations were softening yields. If capital rotated toward metals while shorts remained concentrated near 80, pressure on that level would intensify. Monetary catalysts amplify positioning squeezes. He reviewed historical silver spikes. In prior decades, sharp advances often followed prolonged range periods. Shorts accumulated during stagnation. Then macro triggers shifted sentiment. Covering cascaded. Price advanced faster than fundamentals alone would suggest. Positioning converts gradual tightening into rapid repricing. He also noted psychological inertia. Traders rely on past behavior. If silver failed at 80 before, they expect failure again. That expectation reinforces short positioning. But markets evolve. Conditions beneath price change. When old behavior persists, despite new structure, vulnerability grows. He considered the current setup carefully: physical absorption, weakening supply; monetary expectations, improving metals appeal; short positioning heavy near resistance; speculative longs moderate. And this configuration historically precedes breakout phases. He imagined the moment of breach. Price touches 81. Shorts hesitate. Algorithms trigger buys. Volume expands. Shorts attempt to reassert control, but physical demand remains. Price continues upward. Lost thresholds activate. Covering accelerates. Movement appears sudden, but the cause is cumulative. He summarized internally, breakouts are rarely surprises. They are delayed recognitions. He then examined volatility patterns. Recent silver volatility had compressed within the range. Compression often precedes expansion. Markets coil before release. Participants interpret stability as equilibrium. But equilibrium with tightening supply and heavy shorts is unstable. Energy accumulates invisibly. He returned to charts again. Silver hovering beneath 80 looked ordinary to casual observers. But he saw layers. Physical tightening from part 1, monetary shift from part 2, positioning imbalance from part 3. 3 independent forces converging at one level. Such convergence transforms a number into a pivot. He wrote the final line of part 3. When resistance is tested by tightening supply, under easing money, against concentrated shorts, the level does not hold indefinitely. It yields. And when it yields, price moves not because of hope, but because positions must change. He had traced the mechanics. He had mapped the policy shift. He had identified the positioning trap. But the final layer of the story did not sit in charts or contracts. It sat in time. Because silver was not only a traded asset, it was a long-cycle metal, shaped by decades of monetary change and structural consumption. And what he saw there explained why the number 100 was appearing more often in serious discussions, not as hype, but as consequence. He began with supply. Global silver mining had grown only slowly over many years. New deposits required long development cycles. Environmental constraints increased. Many mines produced silver as a secondary metal, meaning output depended on other commodities' economics. Even when silver prices rose, supply could not expand quickly. This created rigidity. Industrial demand, by contrast, had expanded steadily. Electronics, electrical systems, energy infrastructure, medical devices all required silver's conductivity and durability. These uses were embedded in modern systems. Demand rose with technological scale, not with investment sentiment. Unlike speculative demand, industrial demand does not disappear during volatility. Factories continue production. Infrastructure projects continue installation. Devices continue manufacturing. Each unit consumes small quantities, but across millions of units, the total becomes structural. He reviewed consumption trends. Solar energy deployment had accelerated globally. Each photovoltaic system required silver. Electric systems required silver contacts. Telecommunications required conductive materials. Even incremental growth across sectors accumulated into persistent baseline demand. The key insight was not growth rate. It was irreversibility. Once industries adopt materials for reliability and efficiency, substitution is slow. Engineers optimize around known properties. Supply chains align, standards form. Removing silver from such systems requires redesign, not short-term price adjustment. Thus, demand becomes embedded. He then considered recycling. Some silver returns through scrap recovery. But industrial silver often disperses in tiny quantities across products. Recovery costs exceed value. Much metal remains locked in devices for years or decades. Effective supply becomes permanently reduced. He wrote, "Industrial silver rarely re-enters circulation quickly. This meant inventories carried increasing importance. Each year, production plus recycling met demand partly through drawing down existing stocks. As long as above-ground inventories were large, markets remained stable. But persistent deficit gradually erodes that buffer. Inventory depletion is silent. Only when remaining stock approaches thresholds does price adjust sharply to ration demand. The adjustment appears sudden, but the deficit existed long before. He saw that silver had entered such phase, not crisis, but structural tightening. He then moved to monetary context. Precious metals do not exist outside currency regimes. Their valuation reflects purchasing power of fiat units over time. When currency supply expands faster than metal supply, metals reprice upward to maintain relative scarcity. He reviewed monetary history. Over decades, currency aggregates had expanded substantially. Debt levels rose, liquidity cycles expanded and contracted, metals responded in waves, gold led, silver followed with higher volatility due to smaller market size. Silver's historical peaks occurred during periods of monetary stress or inflation expectations, but present conditions differed. Industrial demand now overlapped with monetary demand. This dual role increased sensitivity to currency shifts. He framed the relationship simply: if money grows faster than metal, metal must reprice relative to money. He did not assume hyperinflation. Monetary revaluation can occur gradually, but persistent liquidity expansion combined with physical scarcity alters long-term equilibrium. Prices adjust to reflect new ratio between currency units and available metal. He then connected this with earlier parts: physical tightening, part 1, monetary shift, part 2, positioning imbalance, part 3, all short to medium-term forces. Part 4, extended horizon, structural demand and currency expansion shaping long-term valuation. The number 100 began appearing in this context, not as immediate target, but as threshold consistent with historical adjustments when metals reprice under combined industrial and monetary pressures. He examined prior cycles. Silver had moved from low double digits to near 50 during earlier monetary expansions. That move reflected both investment demand and currency debasement. Today's structural demand base was larger, supply growth slower, currency supply broader, thus equilibrium range may differ. He wrote cautiously, valuation regimes evolve when demand structure changes. He then considered investor perception. Markets often lag structural change. Participants anchor to past ranges. Silver below 50 dominated memory for decades. Even at 70 or 80, many still viewed price as elevated. But equilibrium shifts when underlying conditions change. Resistance becomes new baseline. He imagined future observers looking back. They might see silver below 80 as historically low relative to structural demand and monetary conditions. Such reinterpretation often occurs after repricing phases, not before. He also noted geopolitical dimension indirectly affecting demand. Nations accumulating reserves often prefer assets outside single currency dependence. Gold historically fulfilled this role. Silver, smaller and industrially relevant, gained renewed strategic attention in some regions. Strategic demand differs from investment demand. It responds to long-term security considerations rather than short-term price. Even modest allocation shifts at national scale can affect markets with limited supply elasticity. This added another layer of persistence. He then assembled full framework. Industrial demand rising and embedded, supply growth constrained, recycling limited, inventories declining, monetary supply expanding, strategic interest emerging. Such combination historically precedes valuation shifts measured not in percentages but in multiples over time. He remained measured. No market moves linearly, corrections occur, cycles interrupt. But structural direction becomes difficult to reverse once supply-demand balance changes fundamentally. He wrote his concluding assessment. Silver's approach to higher valuation is not driven by enthusiasm. It is driven by arithmetic, finite metal, persistent consumption, expanding money. When these align, price does not rise because markets desire it. It rises because equilibrium demands it. The path toward triple-digit silver was therefore not a forecast of imminent surge. It was recognition of structural forces already operating. Resistance levels, policy signals, and positioning would determine timing. But the underlying trajectory stemmed from deeper balance between physical reality and monetary scale. He closed Part 4 with quiet clarity. Levels change. Regimes change. Valuation anchors shift. And when a metal moves from surplus perception to structural scarcity, the numbers that once seemed distant gradually become ordinary.